Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a great day in the markets today. And in today's action, guys, well, the S&P hitting a brand new all-time high. However, it was a very flat day in the markets. Not a lot of very wide price swings across most of our major indexes. The SPY, however, ending the day in the green, and the QQQs ending the day in the green as well. Most of your major action today came from earnings results. Sometimes companies were having big earnings moves on their own, and sometimes they triggered sympathy plays across the rest of the industry. You can take a look right here. Chipotle was down 13% on the day, and that did weigh down the quick service restaurant segment overall. Tesla, the largest mover of big tech, going down about 8.2. IBM, the biggest component of its relative niche in the markets, down 8% after reporting very good earnings. Intel was down as well. Capital One Financial down there, 3.71. UNH and some of the health insurance stocks coming down after UNH finally acknowledging that there is a Department of Justice lawsuit against them for criminal investigations into fraud. Union Pacific coming down, bringing down some of the railroad players after their own earnings. And Honeywell coming down about 6.18% after their own earnings too. So you can see, guys, that most of the big declines on the day were either a result of their own earnings or possibly sympathies, right? Other companies in those same segments that were coming down. But overall, it was a fairly balanced day in the market, just no massive changes. In terms of the news that we got today, well, the news that came out was fairly okay. We did get S&P Global Manufacturing PMI, which measures producer inflation, and that was actually muted, 49.5 versus the expectation of 52.5. Showing once again that inflation from tariffs not hinting at any levels of increases for producers just yet. But we know that these producers have done a great job at managing inventory so far and probably benefiting from the continuous tariff pause, which will be unwound starting August the 1st. So maybe if we start to see any indication of producer inflation because of tariffs, it might just come in the next 2 months, but definitely not right now. And services PMI having a slight uptick here. That was mostly due to seasonality. In the summer months, services tend to have a bit of an uptick, but overall, nothing special in terms of the news. There was one very funny thing that did happen today, and that was President Trump touring the Federal Reserve building. You obviously know that there's some construction going on at the Federal Reserve right now to the tune of almost $3 billion. And this picture, I don't know, I just found this one funny. President Trump and Jerome Powell looking at some building plans and building budgets. President Trump thereafter saying the cost overruns are substantial. But on the positive side, our country is doing very well and can afford just about anything, even the cost of this building. I don't know. I thought that this picture was pretty funny. Obviously, no major news stemming from that. President Trump questioning some of the costs associated with the new construction. Obviously, President Trump having an extensive real estate background of his own. And here you can see Jerome Powell kind of struggling through the numbers, trying to make sense of it all, seeing if they're going over budget or not. Anyways, I thought that was a pretty funny piece of news today. You guys can watch the video. It was actually pretty comical. Anyways, moving on to our markets, guys. In terms of today's video, what we're going to cover together. Number one, we're going to be going over 3 earnings presentations that I have prepared for you guys. Number one, we will be talking about Intel. Is the recovery story underway or not? Company number 2 is not on this board, but we will be taking a look at Moody's Corporation and explaining why it's one of the most largely held institutional holdings in the entire market. We'll be doing that, number 2. And number 3, we'll be taking a look at an apparel and footwear company, Decker's Outdoor Brands. They got absolutely crushed last earnings. Let's see if this earnings, they were able to turn things around. So we'll be covering those 3 earnings to start off the video. Thereafter, we'll be going through our major technical analysis rundown of our major market indexes, see how the rotation is playing out. Thereafter, we will take a look at our big tech name list as well. Take a look at all of our big tech names, which ones are set up good into earnings, and which ones are possibly buys right now for either swing trades or long-term portfolios. I'll give you guys my insights on those. And to wrap it all off, yes, today we will be doing the biggest gainers and losers of the day. Many stocks to the downside, big red, and then of course, many stocks as well, having some very positive gains. So we'll spend about 10 minutes on this list and derive if there's any short-term trade opportunities for you guys. And that's going to be it for today, guys. No portfolio review today. I'll present you guys the portfolio tomorrow when we do the Friday and weekly market recap. True to our fashion, I usually show the portfolio twice in the week, once on a Monday and once on the Friday, so that'll be tomorrow. So without further ado, guys, let's jump right into it, shall we? The SPY up 0.03%, the Qs up 0.21%. Not a bad day overall, but as I was describing, most of the moves did come from earnings themselves on companies or sympathy plays associated with those earnings. Big tech not having a bad day at all. NVIDIA, Broadcom, AMD still crushing it. Microsoft not too bad. Apple down a little bit. Google, sadly, unable to keep up its 3-4% gains that it started the day with, ending just under 1%, and Amazon up 1.73. They have earnings next week. Most of these companies, as a matter of fact, have earnings next week, talking about Meta, Apple, Microsoft, and Amazon, of course. In terms of the financials, fairly mixed overall. Healthcare was fairly mixed. Some of the pharma names were doing well, but sadly, the health insurance providers still dwindling. Big day for them tomorrow, guys. Why? You got Centene Corporation reporting tomorrow. Will they be able to provide any positive guidance for the entire sector? We'll see. Should be very interesting. No position for me, though. And the bottom half of the market, guys, very mixed overall. Lots of earnings moves and sympathy plays there as well. In terms of the one-day relative, you can see just how mixed the market was today. Only 3 major components making it out into the green: tech, communication services, which is largely led by Google and Meta, and energy. The rest of everything, sadly, down. Consumer cyclicals coming down the most, and that was mostly due to Chipotle's earnings, pulling down a lot of different restaurant brands overall. Fairly mixed market on the 1 week relative. We still see no red flags. Most of all your sectors have been performing well. Just today was a bit of a muted day. So before we get into more technical analysis, guys, let us dive directly into the earnings, and we'll try to wrap these up as quickly as possible so we can get into some charts. The first one we're going to take a look at, guys, is Intel. So Intel, it has been categorically, unequivocally an absolute disaster for the better part of the past 3-4 years, stemming from many different issues. Number one, of course, was their lack of cost control, spending way too much money on their foundry division. Number two was their reluctance to pivot from an x86 architecture over to the ARM architecture that other major players such as AMD have been using, which the market seems to appreciate a lot more. And many other problems. Just a mismanaged company all across the board, which has resulted in them being, down from the all-time highs right now, 68%. So for the past 4 quarters that we've been covering this stock, we've been trying to identify where is the turnaround point. Is this company even investable in the first place? Well, I'm happy to say, guys, that if you are an Intel shareholder, things are starting to look a little bit better. The new CEO that just came in about a quarter ago at this time has been doing several very large cost-cutting endeavors, which are paying some dividends for the company right now. Let's move into it, shall we? So in terms of their earnings, unfortunately down 4.24% in the after hours. And that's just because they really didn't have good numbers, right? They were supposed to come in at flat or slightly positive EPS. Sadly, that was not the case, missing the mark there because of some one-time structural charges on the business as a byproduct of the CEO trying to cut costs wherever he could. Revenue, however, coming in at 7.46% to the upside. This was actually good to see. What the CEO is trying to do right now is cut all the fat out of the business and focus on revenue expansion, and more so focus on really only having the production that they need for the demand. One of Intel's problems over the past couple of years is that they just had too much production capacity. They overbuilt for the amount of demand that they had. We know demand for this company had been going down as several aspects of their business were just being challenged by other players. Their entire personal compute division highly being challenged by AMD's offerings right now. And the data center portion of their business, of course, well, NVIDIA and AMD is running away with that on their own. And so is IBM, mind you. So Intel kind of being left behind all across the board. Let's take a look at the article, shall we? Intel beats on revenue, slashes foundry investments as the CEO says, no more blank checks. This is exactly what we want to see for a turnaround story. It will not be a quick turnaround story, and the CEO has said that himself over the past 2 earnings calls, but the turnaround story is underway with several large things being done. Now, moving forward, the company's new CEO, Lip-Bu Tan, announced significant cuts in chip factory construction. Intel said it expects revenue for the third quarter of $13.1 billion at the midpoint versus the average analyst estimate of $12.65. So not only did they beat revenue estimates for this quarter, they actually raised their guidance for next quarter, showing a bit of light at the end of a very dark tunnel. The chipmaker said it expects to break even on earnings, while analysts were looking for earnings of 4 cents per share, talking about EPS, of course, as they continue to kind of wind down certain things and take one-time charges on their income statements and balance sheets. Now, this quarter, we had an $800 million impairment charge, which is the result of, or rather, which resulted in EPS being negative, related to excess tools with no identified reuse. That's how bad it was at the company. They were just building things, and they had absolutely no use for them because the demand wasn't there. The report was Intel's second since Lip-Bu Tan took over as CEO in March. promising to make the chip makers' products competitive again and to reduce bureaucracy and layers of management, including slashing staff in Oregon and California. Tan said that the first few months of his tenure had not been easy. The company had completed the majority of its planned layoffs, amounting to 15% of the workforce, planning to end the year with around 75,000 employees. Intel cutting 15 to 20,000 jobs in the last few months. Intel previously said it was trying to reduce operating expenses by $17 billion in 2025. That is a very large number, and that's exactly what you want to see a new CEO do. Really trim all the fat, cut what's not needed. Unfortunately, some employees are going to have to go with that. But if the demand isn't there, guys, you cannot just keep hemorrhaging money to the same effect that Intel has been doing over the past 2-3 years. Tan also announced several other spending cuts in the memo, particularly in the company's costly foundry division, which makes chips for other companies and is still looking for a big customer to anchor the business. Intel said its foundry business had an operating loss of $3.17 billion on $4.4 billion in revenue. I will show you a chart, guys. The operating margins on the foundry business are an absolute disaster, an unmitigated disaster, or rather previously unmitigated, because now the CEO is trying to mitigate it. Now, Tan said that Intel had canceled planned fab projects in Germany and Poland because there's just not enough demand. He added that the company would slow down the pace of its construction of a cutting-edge chip factory in Ohio, depending on market demand and if it can secure big customers for the facility. Over the past several years, the company invested too much, too soon, without adequate demand, said the CEO. In the process, our factory footprint became needlessly fragmented and underutilized. Tan wrote that the company's forthcoming chip manufacturing process, called 14A, will be built out based on confirmed customer commitments. There are no more blank checks, he said. Every investment must make economic sense. The company's client computing group, which is primarily composed of sales of central processors for PCs, so CPUs, had $7.9 billion in sales, down 3% on an annual basis. So even their core component, the one thing that made them great from the 1980s, 1990s, 2000s, and 2010s, that has still been struggling, guys. Revenue in the data center group, which is supposed to be their best segment of revenue, especially in this environment, which includes some AI chips, but is mostly central processors for servers, rose only 4%. You have other companies, guys, posting double-digit percentage growth in their AI divisions. Sadly, Intel's is only up 4% year over year. Tan added that he would personally review and approve all chip designs before they are taped out, which is the final step of the design process before a new chip is manufactured. So obviously you can see that the CEO is trying to do as best as he can with the cards that he has been dealt. Now, let's move forward, shall we? In terms of the earnings presentation for Intel, I will show you the divisions, and you will see, guys, it's not good. So obviously they're trying to become more customer-centric, engineering-focused, and being consistent in their execution. So Intel has a lot of flaws, guys, right? They fell behind the game in terms of design and innovations. Number two, they spent way too much money, and the foundry business is an absolute disaster. Let's see what they're trying to do for that, yeah? So in terms of your Intel, in terms of the company overall, you can see here, guys, that this, sadly, look at these gross margins, right? Gross margins is the line in the middle of the graph, 29.7. Now, this is slightly better than Q3 of last year, which was the worst quarter, arguably. But still, you can see gross margins have somewhat been dwindling, and revenues are not really increasing at a very fast pace either. In terms of your different product segments, this is the client compute group, personal CPUs. Look at the operating margins, or rather, look at the operating margins here, the white line. Don't pay attention too much to revenues because we know they've been a disaster. Operating margins, though, have just been falling and falling and falling. CEO is trying to work on this. In terms of their AI products, you can see that operating margins have been improving over the course of the past year from 6.5% to 16.1%. So good efficiency gains right there. But look at the revenue. The revenue is just not growing as fast as other companies overall. And here's the infamous foundry business, guys. Sadly, revenue has been flat for the better part of the last 5 quarters. And look at these operating margins, guys. Very, very bad, guys. They're losing, 71% of the money that they make in the foundry business. They're giving back, right? So just not a very effective business overall. Too much costs in terms of that. And the all other segments is a very small portion of Intel's business, but you can say kind of the same thing, right? Operating margins, I mean, they're trying to do what they can. But as the CEO has said, guys, turning around Intel is like turning around a very large cruise ship. It will not happen overnight. Here is more sector breakdown so you guys can see what the company's been doing for the past 5 years. In blue, you have your client computing group. These are revenues. look at the declines in revenue, right? Over the past year, client compute has been flat. Now, I know that client compute has been a rough patch for a lot of companies out there. Microsoft has commented on this, AMD has commented on this, and even NVIDIA with their GPU, their client segment GPUs, not the data center ones, the ones that you and I use. Those have also been rough in the past few years as consumers battle with higher inflation, higher prices, and just not out there shopping for new electronic components just yet. Still, though, Client Compute Group, their best revenue metric, flat over the past 4 years. In green, we have the Intel Foundry revenue. You can see that that one has been a struggle over the course of the past 4 or 5 years as well. Down. In terms of network and edge revenue, that too has been struggling. It's a smaller component for Intel. We do not have the data here by FinChat, sadly, but still no major gains there either. And if you look at the orange segment, which is the data center and AI revenue, they were actually doing better in 2020 and 2021 than they are doing today, despite the entire sector for AI rallying, Intel just not getting a piece of the pie. Actually, other people running away with their piece of the pie. So all things considered, guys, right? We can clearly see that there's a margin problem here. There's a revenue expansion problem here, but the CEO is trying to address some of those concerns by reducing operational expenditures, by firing a bunch of employees, by cutting back on spending on plant constructions and stuff like that in different areas such as Ohio and in Europe. And the CEO is saying that he will have to approve all the designs himself to make sure that the products that they are putting out to the market are actually well received by the market. So taking a look at their numbers, guys, at $21 in the after hours, is Intel a buy right here? Well, at 2025 forward price to earnings at 21, they're trading at a 72 forward price to earnings, but they are growing revenue, or EPS rather, by 94% per year. Now, don't be astonished with this EPS growth rate, guys. They're literally coming off zero. So it's not that impressive, right? They just lost all their EPS since 2021, and now they're coming off zero. So they have a very fast EPS growth rate, but EPS will not come back to a fraction of what it was in 2021 for a very, very long time. Revenues also stagnating. You can see a sheer drop off here. They have lost, for all intents and purposes, 30% of the revenues that they had in 2021. However, it is now supposed to resume a casual and slow pace of growth to the upside. So you can clearly see one common theme here. If we are betting on Intel, it has to be a multi-year timeline. Maybe the market starts bidding it up faster in anticipation of that. But for true fundamental recovery of this business, you're probably looking at something like 2028 to 2030. As a result, there's only one play for me that makes sense here. If we are buying shares down here, you have to be willing to hold them until that turnaround story possibly plays out. And you're not even sure it's going to be playing out, because what if all the other companies just have such a huge lead on Intel and push that into the future as well, and Intel is just kind of left behind perpetually, right? So, in my opinion, it is a play, but it's a play that you should be taking with capital that you can afford to lose, or you can afford the opportunity cost of that capital doing nothing, or maybe just some small and muted gains for some considerable time. Now, another option is possibly for some leap calls. Deep 2027, December 2027, out of the money calls, $30 strike, and you just go for it. Not a very large position, but you're not asking for too much. You're just asking for Intel to come back up into the $30 range, which I know in percentage-wise, it's a very large gain, right? That's like 45%. But still, in the grand scheme of things, it's not asking too much for Intel in the next 2 years. If there's a case of rising tides lift all ships and semiconductors across the board get a bid, maybe Intel does as well. But sadly, this turnaround story is just starting and is going to take a very long time. So any bets that we are going to take on the company need to be very small overall. And that is my humble analysis on Intel, right? Now, moving into company number 2, we're going to be talking about Moody's Corporation, one company that is absolutely adored by institutional investors. It's one of the highest holdings across the board in terms of institutional ownership. And when we're going to go through the analysis today, I will show you why. So Moody's reporting earnings just the other day. Initially, they had dropped after earnings, and we'll get into that, but recovering very swiftly. Now, the one thing this business does well, guys, is that they are a very consistent and very predictable business with a lot of pricing power. Moody's has 2 lines of businesses. Number 1 is their ratings business, whereby they will rate the debt of different governments, different municipalities, different corporations alike. And that is a market share that they dominate with the other large player in the game, S&P Global. For all intents and purposes, there are some smaller players, but for all intents and purposes, S&P Global and Moody's dominate 85% of the total market share. You can effectively call it a duopoly. When you have a duopoly, you can almost have unlimited pricing power. That's the ratings business. Number two, they have an analytics business. Since they have so much corporate data, they sell that data as a subscription service, which gives them a very nice pipeline of annual recurring revenue. Let's take a look at some of the numbers, shall we? So Moody's up 5.16, beat on EPS, and a nice little beat on revenue by 2.65%. Now, we're not going to go through any articles because, to be quite frank with you guys, there are none. It's just such a boring company, and that's why I really like Moody's. It's very boring. All it does is grow segment revenues. Oops, excuse me, that's not the right chart. All they do is grow segment revenues every single year. So here you go. Moody's Investment Services, which is the orange line right there, that started coming down because as interest rates are higher, companies are not necessarily refinancing their debt just yet. But we do have a fantastic pipeline of debt refinancing coming in the next 2-3 years. And that is one of the major investment theses for Moody's Corporation right now, is that this investor services division has somewhat been a lackluster performer in the past 3-4 years. S&P Global is the same because they're not getting the amount of re-ratings that they need in terms of debt because not many people are refinancing because rates in the United States have been roughly flat for, let's say, the past 3 years. They've been held high, and as a result, companies are not refinancing their debt just yet. But as we move into a rate-cutting cycle, this sector has a lot of money that it can go get. Now, in terms of the analytics revenue, look at the consistency of the analytics revenue, which is the chart in blue. Let's move into some of the earnings highlights, shall we? So in terms of their second quarter highlights, MIS, in terms of their ratings business, second consecutive quarter with over $1 billion in revenue. That is the highest Q2 revenue on record. Adjusted operating margins up to 64%. That was an improvement of 1 percentage point. And in terms of Moody's Analytics, well, adjusted operating margins had a nice increase here of 3.6% on a year-over-year basis. Very strong, guys. This is a company that generates a ton of capital, not only in terms of net margins. You can see here that the net margins for Moody's are in the high 20s to low 30s for the most part, but also a tremendous amount of free cash flow. Very advantageous amounts of free cash flow per year, which allows them to do one thing, and that is to buy back shares all the time. They're continuously buying back shares. That's very good for you as a shareholder in the company. Moving on to some more earnings slides for them. So here we can say that the revenue outpaced issuance by 12%, meaning that they're able to, even though the debt repricing cycle has been a bit slow, as we can see from this chart right here, they're able to increase prices. So that's what they mean when they're saying that issuance is down in terms of companies that are looking to refinance debt and re-rate their debt. However, the revenue was still good, right? Because they benefit from a lot of pricing power, operating margins coming a little bit higher. Moody's Analytics division here, very good, guys. 11% revenue growth year over year, 96% recurring revenue, and a 93% retention rate. These are absolutely phenomenal numbers for the business overall. Now, if we move forward, the only reason why the stock dropped is because there was a slight decline here in the amount of leveraged loans in terms of debt re-ratings that they were possibly going to do throughout the year. That is the only thing. Everything else stayed pretty much the same in terms of annual guidance. But in terms of their investment services here, in terms of the ratings business, the only thing that caused the stock to drop is that they had a less amount of leveraged loans that companies were looking to refinance overall. So that is the one thing that brought them down a little bit. You can see here in terms of the issuance, decrease in the low single digit to mid single digit percentage range. That is down from high single digit percentage range. And the only reason why is because of this one component right there. It is a fairly decently sized component for the business, but you can see here, there's no changes, guys, to the guidance for the end of the year in terms of adjusted operating margins. No changes in the analytics division overall. It's really just that one pain point, investor services. But I'll show you guys in terms of the EPS, they were actually able to raise the bottom end of EPS, both in terms of diluted and adjusted EPS. They were able to raise the floor by a fraction, by about 25 cents, but that was very good. No change in the share repurchase plan. They will still be buying back a whole bunch of shares throughout the year, and no changes to free cash flow. These are some very important components for Moody's, and no change to operating margins either, as well as revenue or operating expenses. So no changes, guys, just slight changes here in certain segments of the revenue for their investment services business. But all in all, guys, such a strong company. Here's the tailwind, guys. We have $4.9 trillion of debt refinancing that needs to be refinanced between 2025 and 2028. I believe they give a pipeline of the debt. If I can find the chart real quick, here it is. This is the one most important chart for Moody's which is why it is a very good investment thesis for the next 3 years. I was showing you guys that this segment was kind of lagging behind, right? It came down in 22, 23. I mean, it's catching up with 2021, but it's doing that from pricing power alone, not necessarily because it's doing a whole lot more re-ratings of debt. Take a look at this, right? Look at the terms. 2026, there's going to be a lot more. 2027, a lot more. Look at 2028, guys. $980 billion of debt that needs re-rating. So they will definitely get a very good piece of that pie, looking very good. And that's if you're looking at corporate bonds and loans, right? And then you have also the Europe, Middle East, and Africa as well. So US and the other major segment for them, both will be needing a lot more debt repricing in terms of the next years. Overall, guys, a very boring report. There is nothing to see here. There's tons more slides and stuff like that, but I presented you guys, you know, the crux of the argument, all the things that you need to understand from Moody's. So that being said, is Moody's a good buy right now? Well, if we take a look at their metrics here at $510 per share, we can see that they're very close to the all-time highs. But truly, guys, has this company really done anything in the past year? Not so much. It's a very wide range of accumulation. Pop above the top, that's when they were going for it. Then we got the tariff effect, and now we're kind of right back here. But the company's been accumulating here, and with the debt repricing pipeline for the next 3 years, a ton of revenue will be generated from this company. They have a ton of recurring revenue from their analytics business. So I think this one is a very good bet. This one and S&P Global into the next few years, I think are going to be very big winners as they have that debt repricing pipeline, a very wide pipeline, right? So at $510 right now, it's trading at a forward price earnings of 37.09. That is standard for Moody's. Moody's usually trades between high 30s and mid 40s in terms of forward price earnings, just because their revenue streams are so consistent and predictable. The price to earnings multiple here, or the PEG ratio rather, is 2.47. That is normal. It's a little high, but as I've labeled here, it has a very high moat, right? They're growing EPS very nicely, but this is standard for the company, and a trailing 12-month free cash flow yield of 2.8%. It is very rare, other than back here when we covered this stock on the channel as well. It is very rare, other than times of big bear market drawdowns, it is very rare to find Moody's at a good price, at either a fairly valued price if you're to run discounted cash flow models on it, or an undervalued price. It just does not happen. It has a high valuation because of the consistency, the predictability of its earnings and revenue streams, and because it has such a high moat. This company is effectively a duopoly with S&P Global, at least in half of their business, which is the most important portion of their business, which is the ratings business. So I do think that even though Moody's is a little bit expensive right now, I do deem this stock to be a buy. It's one that is loved by institutions alike. It's a very consistent stock for your portfolio and may just be one that you might want to explore. If I had to embark on a DCA process, I would be buying some right here. And in the event that we do drop a little bit back down under the 500 range, I would just be accumulating some shares. Not also a bad company to perpetually DCA with some paychecks. It's very consistent. It tends to outperform the SPY on long-term time horizons. And that's everything we had for Moody's Corporation. Now, number 3, what we're going to be getting into is Decker's Outdoor Brands. So Decker's Outdoor Brands is a stock that's had a couple issues in the past 6 months. It all started, of course, with the consumer discretionary spending narrative caught up with them. They had a little bit of a mishap here in the past quarter back in January when they said that, consumer discretionary spending and the macro environment wasn't very favorable for the business. And that was despite showing double-digit growth for several of their brands. Last quarter, they had another almost 20% decline after earnings. This time, not because their brands were struggling, their brands were actually doing well, but because they mentioned that they may have to take an impairment of around $150 million because of the potential impact of tariffs. So the question this quarter was going to be about how much are tariffs actually affecting the business, and are their brands still doing well? And I'm happy to report that the company right now is up about 14% in the after hours after their earnings. If I can just put this on right there, you can see a very, very good pop from the bottom to the top today, almost 14% in the after hours, because the company once again showed that a lot of their brands are being extremely resilient, and their reliance on China is maybe not so much as other people expected. Take a look at the numbers right here. Beat on EPS by 36%. That was fantastic. And a nice beat here on revenue by about 7.13. If we take a look at some of the numbers overview here, we can see that revenue is up 17% year over year, EPS 24% year over year, net income 20% year over year as well, and the expense profile of the company is not rising as fast as their revenues. So you can say that the company is benefiting from operating a leverage, meaning that they are able to scale, and while they are scaling, they are not incurring additional exponential expenses. So they're keeping their costs under control, which gave them fairly decent net margins overall for the quarter. Let's move into some earnings highlights right here. For the second quarter, Deckers said it expects sales of 1.38 to 1.42 billion, the midpoint being 1.4 roughly. The top end of the range was above the FactSet forecast for 1.403. So all in all, the guidance for the second quarter is not going to be too bad. I mean, they run one fiscal quarter essentially behind the market right now, but just consider that this is for next quarter overall, okay? Management projected earnings per share of $1.50 to $1.55. The midpoint, of course, $152.50, and that is above the estimates of $151. So guidance actually came in above the expectations ever so slightly. Number two, though uncertainty remains elevated in the global trade environment, our confidence in our brands has not changed, and the long-term opportunities are significant. Deckers, in its most recent annual report, said that less than 5% of its finished footwear came from China, the main target of President Trump's trade war. The rest came from Southeast Asia and mainly Vietnam. So, saying that the tariff charges that they will possibly face may not have been as bad as they had previously forecasted in Q1. Q1, they kind of gave the worst case scenario, and now I can actually see that it's actually a little bit better than expected, especially since they're able to pull better margins. So here we go, guys. Revenue increasing 17%. That's not very bad at all. Look at the different sales metrics. Hoka brands, 19.8% bump year over year in terms of sales increases. UGGs, 18.9% higher, which is pretty good. However, the other brands, which are a smaller component of revenue, only $46 million of a total of 964, right? Well, they were down about 19%. So the two main things that are driving this business higher are these two brands right here, Hoka and UGG. And we're going to get into that in the next slide right here. Cash and cash equivalents was $1.72 billion, which is very solid, and the company has no outstanding borrowings. Very strong balance sheet position. The company also had about $2.4 billion remaining under the stock repurchase plan. So buybacks for the company, that is a huge amount of buybacks, guys. That is 15% of the float, and that authorization is good for the next 2 years. So you got a lot of buybacks coming for this company overall. However, the one concern for Deckers Outdoor Brands, and we're going to get into whether or not it's a buy or not, okay? So the one main concern for this company, here you can see that I've labeled all the different main brands that Deckers Outdoor of the Deckers Outdoor umbrella, right? So here we go. The UGG brand wholesale revenue is the dark blue line right here. You can see that that brand has been doing wonders to lift the company, especially in the past few years, especially internationally. Very popular in Asia is this brand. Number two, Hoka. That has been the highlight for the company. So UGGs is kind of like the go-to, the cash cow for the business. But Hoka has been the thing that's really taken off here since the onslaught of the pandemic, rallying, 5x or almost 5x, 4x right now, as a matter of fact, in terms of overall revenue gains. Very strong is Hoka brands, right? Now, the total other brands wholesale revenue, look at this purple line right here. Their other brands are not really doing too much. And of those other brands, we have Teva and Sanuk. Teva right here, you can see that, well, the company's not really doing much progress on this brand. That's the green bar. And in terms of Sanuk, which is a very small portion of the business, you can actually see that that brand has kind of been falling off over the past 10 years. So fashion is a very tough niche to be in overall. It is hot one day and then not hot the next. Sometimes it can just never uptick, such as the Teva brand, which is just maintaining. UGGs had a very nice performance over the past 3 years, and Hoka has really been the highlight of the company. So you can clearly see that, yes, the company right now, we'll get into the valuation. The company's trading cheap, guys. However, there is one thing that we kind of need to establish for Deckers Outdoor Brands. And that is a simple fact that, as you can see, it is heavily reliant on the continued outperformance of Hoka and UGGs. If these two brands slow down in terms of year-over-year comparisons, which they probably will, this growth, obviously, this level of growth for Hoka will not last forever. It raises the concern, right? Does this company have a competitive advantage? Do they truly have a moat? Or do they just have a very fashionable product right now that may not stand the test of time in the future? I'm not saying that the brand's going to fall off in the next 1 to 2 years, but is it a 5, 6, 7+ year investment? Maybe not. So this one is the tale of two different aspects. Number one is the fact that it can represent a very decent trade because right now the company is somewhat undervalued. At 114, the price in the after hours after the earnings push, they currently stand at about a forward price earnings of 18.8. The forward PEG ratio right now is 1.7, which is very decent. Free cash flow yield is amazing. Their balance sheet is amazing as well. Revenue and EPS growth is slated to be very good over the next few years. And they're doing an absolute ton of share buybacks, which will lead them to have very decent increases in EPS, at least when measuring over the next 3 to 4 years. Revenues will be increasing over the next 3 years as well, but I worry about a possible drop-off in the revenue run rate come 2027, 2028, if the company does not have another product that really starts coming in terms of very rapid sales appreciation. So Decker's Outdoor Brands for me is a trade. A trade from where? Well, possibly a trade from here all the way up to our area, the next area of resistance, 140 up to 152. And as you'll notice here, from the midpoint of the analyst price targets, about 122 to 150 is the top end of the range. So I don't mind this one for a bit of a swing trade back into our large area of resistance, which stands up here, 140 to 150. I don't mind it for a swing trade. I think there's a nice opportunity for a swing trade here, especially when we start getting some better consumer discretionary numbers, maybe over the next few quarters, which will possibly also uptick Nike, possibly also uptick other brands such as Louis Vuitton and other things of that nature, right? We know that apparel has been a very tough landscape, as have been restaurants too. And that consumer segment, the consumer discretionary segment, should be coming back possibly into 2026. I do believe there is a trade here. However, this one would not be a long-term investment for me because I just deem there to be a lack of a relevant moat overall. They're capitalizing on a very nice trend for a few of their brands, but I fail to see the company's moat other than the fact that they have a very fashionable product and a very trendy product right now, which is fine, and we can play social trends like that, but you have to acknowledge it for what it is. That's everything that I had for you guys for Decker's Outdoor Brands, and that recaps all of our earnings. Hopefully you guys enjoyed those. In terms of earnings recaps that we will do tomorrow, we'll do a couple ones that we've missed so far this week. I'm thinking tomorrow we might do something like a ServiceNow, an IBM to talk about their earnings, but then also we'll probably cover the home builders because there's a thematic trade at play here, which I've been talking about on the channel for the last few weeks. So tomorrow we'll do IBM, ServiceNow, and do a deep dive on the home builders to see whether or not these could possibly be subject of very good investments or very good trades maybe for the next 12 to 18 months. But that being said, that wraps up our earnings season, our earnings calls for today. Hopefully you guys enjoyed. Now let's dive into some charts, shall we? All right, we're going to start off with the S&P 500 here. So the S&P 500, guys, we're going to go through this quickly because not much has changed, right? Very muted price action. Daily uptrend is clear as day right now. Any move lower, we're going to be looking for a higher low. Anything above 618, you guys know the drill. Looking for the higher low for possible further trend continuation. If you are looking for the breakdowns of the market, you should be looking for two things. Number one, a reset into a daily downtrend and a loss of the 12 EMA. The bulls have been grinding this 12 EMA for the better part of the past 3 months. Suffice to say, if they don't lose that, you will not see any meaningful weekly pullbacks. And if we do get a meaningful weekly pullback, establish who is in control right here. Clearly the bulls, looking for a weekly higher low on any substantial drops. Anything above 592, looking for a higher low for further trend continuation. So rather than trying to predict the markets, when the market's going to drop, what's going to be the next catalyst for the drop? Is it August 1st? Is it September? Is it XYZ? Just let them show you when they actually want to set the downtrends overall, right? Just look at a stock like Netflix. I always bring up Netflix, yeah? When something grinds the 12 EMA for a while, 3+ months, and then loses it with a loss of the 12 EMA, and then a daily downtrend, then and only then do you know that weekly extended consolidation is underway. For now, though, no red flags for the indexes, right? So we got to stop guessing, guys. Let them show you, right? Moving on to the Qs right now, same concept. The bulls remain in full control of this chart right now. Higher lows are now set at 550. Daily uptrend is still very attractive right now. Any move lower, just looking for a new higher low. They are still grinding this 12 EMA. Same concept. Let them show you when they're done, right? You'd be noticing a loss of the 12 EMA and a daily downtrend, and that would lead to a bit of weekly consolidation. As of right now, though, the bulls in full control, the weekly bulls, not looking back at all right now. Big tech earnings next week will be front and center, and we will see if big tech earnings are all bad, which would be surprising. Then we can maybe expect some weekly consolidation. If they're all good, you would not be surprised to see the bulls grind even higher. I know. The more extended we go, of course, it's going to result in a eventual pullback, right? But very tough to say whether the pullback is coming now or maybe after one little leg higher after those tech earnings. Moving on to XLF financials right now. Financials down about 0.06% on the day, but very flat, guys. It was a daily downtrend, nice engulfing move by the bulls. We are looking for a trend recapture to the bulls right now, right? So any move lower, anything about 51.34, looking for a higher low for possible trend recapture by the bulls right now. The weekly chart paints the clearest picture, in my opinion, for financials. This is a beauty, guys. Back test of support, which was 52.10 down to 50.31, just looking for a future leg of expansion. And not all financials have been built the same. The entire insurance sector has been left behind. You need to look no further as names such as Berkshire, which is mounting a bit of recovery right now, right? But other companies such as Allstate, they've been down for like 2-3 months. PGR, they've been down for 2-3 months. A company like Chubb, they've also been down for 2-3 months. We also have the credit card companies not pushing new highs. Visa and MasterCard, they have earnings next week, both of them not pushing new highs for the better part of the last 6 months. That's Visa, MasterCard as well, not pushing new highs. So the banks have been doing well, but we're kind of missing several other parts of the segment right here. The insurance companies and some of the major credit card companies as well. That is going to be the catalyst that you're looking for a bit more lift on financials. But as of right now, no true red flags. Healthcare dropping a little bit today, and we are still stuck in this very wide range of price action right now. So the cleanest time frame, in my opinion, is the weekly. Pay attention, 137.50, guys, is going to be looking for the break here. If the bulls can do that, you're going into a brand new weekly uptrend. If you don't, you're looking right back down here to the bottom end of this support area. It's a good accumulation zone for healthcare because healthcare has been lagging behind the SPY for a very long time right now. Monthly downtrend, you're just looking for a little bit of life to be breathed into the sector. We will see if tomorrow's earnings can do it. Centene Corporation and HCA Healthcare. In my opinion, guys, it's going to be very tough for the healthcare sector to rally without the healthcare insurance providers. Even pharma, guys. Pharma has been left behind, and medical devices haven't really been performing too well either. The entire sector, in my opinion, guys, is somewhat undervalued right now, especially in relation to SPY. You can see here, we have a lot of divergence. Right? Whoa, that's a big chart. Just look at this divergence right there. Usually these two charts do not diverge this much. I don't know why it does that sometimes for me. Look at the divergence. Usually they move hand in hand. Let me just try to make this a little bit better. It's not going to do it. Sorry about that, guys. I don't know why it's doing that for SPY. Wait. Oh, I know why. Because TradingView gave me the wrong ticker. Give me a second and we'll do this analysis. You guys have seen me do it a few times over the past minute there. Let me see here. Let me just do the S&P 500, or rather US 500 here. We'll just make it easy. So US 500, same percentage scale. There we go. Sorry about that, guys. Right? Technical difficulties. So they've been diverging a lot, right? And usually these divergences do correct in the direction of the overall market. So we're going to be looking for healthcare to play a little bit of catch up, because they've been deeply, deeply lagging behind. You can see here, the last instance of that was here. Eventually, healthcare did play a bit of catch-up while the markets dropped, coincidentally. So maybe we're going to be looking for the same thing, right? Looking for healthcare to kind of pick up the slack if ever some of your more tech-oriented sectors choose to go into a little bit of consolidation. Semiconductors right now up 0.42%. No red flags on this chart. Just kind of chilling here at the highs. We are really oscillating with the 12 EMA. The bulls playing a lot of defense right here. The one thing you got to notice, guys, they cut the lows, but we're not flushing just yet. You need to see a break further down below 282. Then the daily downtrend will be well established. And then you're looking for a little bit of weekly consolidation. A little bit of consolidation here at the all-time highs, but still no red flags. Next pullback zone for SMH, probably back into here around 278. And the furthest area away, 260 to 250. The difference is the weighting, right? SMH has different weightings in its top holdings. NVIDIA, Broadcom, TSM, stuff like that. SOXX, you can see a better pattern right here, right? Beautiful weekly uptrend, same as the SMH. If you do pull back, this is a easier play in terms of a pullback for that entire ETF. If you're looking to play the ETF, 235 down to 222. Beautiful breakout retest pattern for possible further trend continuation. So one or the other, depending which one you're looking at, is fine. But semiconductors still looking very strong. The short-term bulls in control. Any weekly pullbacks will be buying opportunities, in my humble opinion. The Russell today, 1.38% to the downside. Sadly, so still not able to mount over and above this resistance range, 225 to 231. This, guys, is a very important range, right? Resistance from back here, but also that's the 2021 resistance highs. And as long as yields keep playing these games of being high, it's going to be very tough for the Russell to really just blast off, you know, as if we're in a low rate environment, a very high growth environment overall. The clearest time frame, in my opinion, as the daily is kind of just trapped in somewhat of an awkward range. Yeah, we are maintaining the 12. It's very, very, very choppy price action A lot of that action is due to the movements in yields intraday or from day to day, rather. The cleanest time frame is the weekly, right? The bulls still control this right now. A little bit of sideways accumulation right there between two zones, between resistance and support. One trade for me is in the event that we somehow retest the lower bound here, 217 at 208. I might be looking to position for a little bit of a swing trade long, but as of right now, no trade on growth for me. The outlook is just still a little bit too cloudy for my liking on that sector overall. The VIX, the dollar, and the yields will kind of skip over because they're just oscillating. They're not doing much of anything. If anything truly changes on these charts, I'll bring them up. Maybe I can only cover these, once every few days or something like that, just to save time on the videos, right? I'd rather spend more times on stocks rather than those charts. In terms of gold, gold is still in a very nice uptrending pattern. The bull's looking for a higher low in around the daily moving averages. Not too bad, but gold has been kind of just moving a bit slow too. We still have a bullish leaning bias. Weekly uptrend is looking nice. But in the event, guys, in the event that the bulls lose this daily uptrend, which would be surprising, it's not looking too bad, right? In the event they lose it, you're coming right back down here again to about 3,300 to around 33, down to about 3,250. Sorry, these boxes are the wrong color. This should be green. It's bugging me. My OCD is kicking in right now. Let me just change that for you guys. This should be green. This should be red to illustrate the clear difference between support and resistance, of course, right? So now we're kind of back testing prior support. It's a back test of resistance, which is now support for the bulls. They're not looking bad right now. There is a swing trade opportunity to be had immediately. And that's if your stop loss is below 3,300, take profit should be around 3,500 all-time highs. There is a swing trade long. It's not the best risk reward, right? It's kind of equidistant right now. If you're looking at a stop loss down below there and take profit up here, actually, you know what? My mistake. The chart looks bad, but it is a 2-to-1, right? For that price target at 3,500 versus a stop loss under 33. Not too bad. Just looking for the continuation of the daily uptrend and the continuation of a possible weekly uptrend by the bulls as well. The chart not looking too bad. It's just gold has been a little bit slow as of recently in terms of the size of the moves, right? In terms of Bitcoin right now, Bitcoin down about 0.26% today, but they're just doing a whole lot of nothing, guys. This is like an extended bull flag. The bulls are kind of grinding this 12 EMA, which they've been doing for a couple weeks in a row right now. Just pay special attention, guys, to this line right here, 116. If you crack 116 to the downside without new highs, that's a daily downtrend, and you're just going into very healthy weekly consolidation, right? The bulls did a tremendous push beyond the all-time highs, and any moves lower, just looking for a higher low, guys. Just watch for a pullback, 111 down to 109. That would be the next buying opportunity, in my opinion. Casual retracement, very normal price action on Bitcoin right now. And if you don't get that, because this is technically speaking a bull flag right now, right? Tightening up at the top end of a nice push. The bias is still bullish right now for expansion into 125. But I figure I should give you guys the breakdown scenario because that's when most people start to panic. Just understand that the bulls are still largely in control and you're just looking for a bit of a higher low. 111 down to 109 could be a very interesting backtest location for Bitcoin in the event that we do tend to drop the levels right there. That's everything I had for you guys for the overall market rundown. Now let's dive into some big tech names. All right, so starting off with Apple here. Apple down about 0.18%. Still no progression on the price action for Apple, guys. Apple's kind of been stuck here for the better part of the last few weeks in a somewhat tight trading range, right? From these tops to these bottoms, about a 3% range. The bulls are in short-term control, though. However, we have earnings next Thursday, so there's not too many days of price action left for Apple. I would be highly surprised if Apple's able to breach the top end of resistance before then, 220 down to about 213. I would also be very surprised if Apple somehow revisits the bottom end of support down here, talking about the lower 200s. Maybe we just stay somewhat muted, but into earnings, the bulls do benefit from a very nice daily uptrend, looking for a higher low, anything above 207, looking for a higher low to possibly push a little bit higher, maybe for a pre-earnings run-up. And in terms of the weekly timeframes, guys, the bulls are not looking too bad, right? They've generated a lot of space right now. We're kind of tightening up right now, but still no clear price action. I think most of the move will be done after earnings. One thing's for sure, if Apple comes back down to the 200s, I will be looking to sell some put options in the lower 200s. And in terms of long positioning, you guys already know, I have a leap call option, June 2026, 220 strike. I paid about $2,000 for it. I'm just looking for an expansion at some point now, throughout next June, back to the all-time highs. I'm not looking for crazy expansion from Apple. We know that they have their problems in relation to the tariffs, in relation to a slower than expected iPhone refresh cycle, in terms of flat revenue growth roughly for the past 3 years at this point. So they have their problems, and of course, the slower than expected AI rollout, which they've been struggling with. That being said, I've brought up this point on Apple right now. It might just be a very nice catch-up trade, right? I'm not looking for crazy gains. I'm just looking for Apple to catch up on a year-to-date basis, not looking for it to catch up to Microsoft, but just less red on the year-to-date performance overall. And into next year, just looking for a push back into the 240s. We'll see if earnings can actually be the catalyst to kick us off there. Moving on to AMD. AMD up another 2.19% today. I know what you must be thinking, guys. It used to only go straight down, and now it's only going straight up, and it's not giving you guys a new entry. And I've been talking about this for the last month. If you're waiting for an AMD entry, you may just be waiting for a very long time, right? Probably weekly consolidation is not going to come just yet. That being said, we can DCA into the position. It's okay if we're buying higher, if we have a long-term thesis. Let me get into the chart, and I'll explain what I mean. Weekly option is very nice right now. The bulls have a lot of space, so on the daily, if you do start pulling back, every single one of these declines into supports are relevant buying opportunities for possible further rallies, right? They've been grinding this 12 EMA, looking very solid. In the event that you lose this and go into a downtrend, you're just looking for a weekly higher low. Same thing that happened back there, guys. You slow down a little bit, weekly higher low, almost into support, and then another leg higher. If we do it again, might just be looking for a new weekly higher low. 153 down to 146 is the mark. If we come down into there, that is the location I'd be looking to sell puts in the market. AMD looking very strong right now, and the valuation in around the 155 range is still cheap. Still trading at a 1.33 forward peg, guys. Very cheap in terms of the overall semiconductor landscape. They'll be having a tremendous push on EPS, tremendous amount of push in terms of revenue for the next 2-3 years. So if we're buying this with a 2-3 year time horizon, we are not late, guys. My target for AMD in the course of next year is mid 200s, and by 2027, you could be looking at $300 per share. The valuation would support that expansion before it starts getting as expensive as other semiconductor players in the space. So keep that in mind, guys. In terms of AMD, I do believe that all dips are going to be for buying opportunities. Moving on to Amazon right now. Amazon up 1.73%. Very good day. Funny enough, Amazon actually rallied more off of Google's earnings than Google ran itself, namely because of the advertising revenue that Google posted, but also because of the substantial cloud revenue growth that Google posted yesterday as well. Amazon clearing the resistance range in a very substantial way. Daily uptrend is very nice on Amazon right now. Any move lower looking for a higher low, anything above 222, looking for a new higher low for possible further trend continuation. They have earnings coming up next Thursday as well, so keep that in mind. I'd be highly surprised if Amazon pushes a new all-time high before earnings. I'd also be highly surprised if they give back this entire newly established support range, because now that we're through it, now we can call this established support. It was support back there and resistance at the same time. Now it's going to be newfound support, and the bulls are looking very strong on a weekly time frame. I still love Amazon, and I still think Amazon is good for 240, 250 a share, possibly this year into next year and a half, next 18 months roughly. Would not be surprised if this one is going to push closer to $300. All of their lines of businesses, guys, are firing full steam ahead. So although I am not buying as much Amazon as I was earlier this year, I am still a buyer of Amazon at this location. It's not a full send YOLO massive call options here. No, that should have been done down there. But this is a decent time to be adding 2 shares for a long-term portfolio. Moving on to Google right now. Google up after their earnings, under 1%. Sadly, Google giving a little bit of that back, but earnings were fantastic, guys. We got to calm down about Google, right? They posted ridiculous numbers yesterday for their earnings, and I'm very happy as a Google shareholder with those earnings. That being said, sure, they could have upheld their earnings push a little bit more, but the chart is still looking very nice. That being said, daily uptrend is quite casual right now. Any move lower looking for a higher low, anything above 181, looking for a newly established higher low. And good thing, if we close the weekly chart like this, above the resistance range, I will close this box green. This will establish weekly support ranges of 191 down to 184. Looking pretty good, guys. Is Google still a buy? Well, we covered it yesterday in earnings, and the conclusion was, yes, indeed it is. This company is still undervalued, in my opinion, at 190 right now. You're still going to get a good deal. So we have to stop having, recency bias that Google only goes down. We have to stop having anchoring bias saying, I could have bought it here. I could have bought it here. So now I don't want to buy it up here. Objectively speaking, are the numbers good leading into the next few years for price expansion? The answer is yes. My price target for Google over the next 2 years is mid 200s all the way up to about 275, 280 through 2027. There is a good deal of appreciation left to be had on this stock, and they're really dispelling any concerns that their search moat is under pressure. Moving on to Meta right now. Meta up only 0.17%, but we know that they have earnings next Wednesday. So you're probably not going to see a breakout of the all-time highs on Meta before earnings, but you're also probably not going to see a breakdown below the support range right there, which is, the prior slight area of consolidation, I will admit. That being said, we have short-term price action control from the bears right now. Any push lower, just a perpetuation of or perpetual control of the daily downtrend and a bit of a weekly consolidation period. Anything above 679, still looking for a new higher low. Earnings is going to be the catalyst, guys. Meta usually moves 5 to 7% after earnings. If they move higher, that's a new all-time high. If they move lower, we will flush these lows, and then I will be a net buyer of Meta. If I can find, 675, 650 per share after earnings, I will definitely be a big buyer of Meta. But for now, no positioning for me. I bought all the Meta shares that I wanted to buy during the April correction, rather, and I'm just kind of sitting on what I have. Not a bad idea to be adding in the low 700s. I'm going to wait to earnings to see what they have to say. Moving on to Microsoft. Microsoft up 1% today. They have earnings also coming up next Wednesday. So Microsoft as well, it's going to be a question, guys. Microsoft, since the bottom of April, right? You're talking about 44%. This is not Palantir, guys. You're talking about a $3 trillion company, almost $4 trillion, moving that amount in that short time span. There's going to be a lot of focus here on earnings to whether or not they deserve that move, or maybe is something going to happen like Netflix, to where even if they report very good numbers, maybe it just sparks a little bit of profit taking, not a sell-off. It'll be a normal profit-taking measure for this business. So keep an eye on the 12 EMA, guys. All the focus is going to be on the 12 EMA. Not that much in terms of price action left before Wednesday. Only a few trading days left. So I'd be highly surprised if Microsoft does this before earnings. But I'll also be highly surprised if they do this, right? Probably the earnings is going to send it in one direction or the other. That being said, if we do consolidate, the bulls have a lot of space here. Anything above 356, just looking for a new weekly higher low. Very extended on the weekly time frame. So I'm not a buyer of Microsoft here before earnings. No way. I bought all the shares that I wanted to back here in the consolidation range at the lows. And the last batch that I purchased was at the tariff lows. Now I'm just riding what I have. So Microsoft is a hold for me. It's not a buy. It's not a sell. It's an extremely high quality company, just at the top end of the valuation range for itself right now. Now, moving on to Netflix. I see I slouched down in my chair. I kind of disappeared on the screen right there. You only saw my head. My bad. Moving on to Netflix right now, up about 0.34%, but we know the bears have been in control of this chart right now. If you get a bounce, you're looking for a lower high. Anything below 1277, looking for a lower high to possibly continue the daily downtrend. That being said, guys, if you want to see this trend end and start a new daily uptrend, you need to get a nice size bounce, 50, 60+% retracement, and then give me a daily uptrend reset. Then and only then will you understand that the weekly correction is currently finished on Netflix. Until the time that happens, the bears remain in short-term control of this one, and we did flush the weekly lows. So keep in mind, we have lost the weekly uptrend, which doesn't mean you're in a downtrend just yet. That would need something like this, but it does mean you are into monthly consolidation immediately. I'll be looking to $1,100 to possibly reposition in some shares. I think it's going to be a healthy pullback for Netflix, but we covered their earnings just a few short weeks ago. They were absolutely fantastic. It's just the stock ran too much, guys, too much in a too short period amount of time. On to NVIDIA right now. NVIDIA up 1.73% on the day. Very nice daily performance by NVIDIA. So testing the all-time highs previously established. No new all-time highs just yet. The bulls, full control. Daily higher lows are set right now at 164. If you don't set new all-time highs and flush, you're looking at a daily downtrend. You're looking at a loss of the 12 EMA that they've held for a long time now, 3 months. And then you're just looking for a healthy weekly consolidation. Just Netflix should be the benchmark, guys, for when a long-standing rally ends. What you're looking for. You're just looking for a healthy retracement for a fantastic company. Where can we maybe move into if the weekly gets a little bit spicy here? 150 down to 140. So if we have a rapid decline in price, I'll be looking to sell some options down there on NVIDIA. No positions for me on NVIDIA right now. I think you're highly late. I mean, if we weren't accumulating shares for the last year and we also didn't buy the tariff lows, what are we doing buying up here, guys? The fundamentals of the business have not changed at all. They've still been as strong as they have been. They haven't necessarily found new revenue segments. They're not accelerating revenue. If anything, revenue is declining year over year in terms of the growth. It's still very solid, but you're talking about a company. I mean, when I talk about revenue declining, right? Let's get one thing straight. I'm not saying revenue is going down. I'm saying the rate of growth is declining, right? Super fast-paced growth. It's declining into the next few years. So please keep that in mind. At 170, guys, the valuation is not too bad. So NVIDIA for me is not a buy. It's just a hold right now, right? Moving on to Tesla. Tesla down 8.2%. We covered their earnings yesterday, and their earnings were just not good. And no matter how much we tried to embellish this with the long-term thesis, Eventually, the car business struggling right now is going to be front and center for cash flows, EPS, and margins. That being said, the cleanest time frame for Tesla, in my opinion, remains the weekly. We currently have a very wide tightening range. It's like a 20% tightening range right now. Accumulation zone, right? Not too bad. Accumulation above support, 300 down to about 258, and overhead resistance stays planted at 362 down to 340 roughly. So there is a tentative buy right here, but it's a swing trade buy. Stops would have to go below this guy right there, because then if you break that, that invalidates the entire setup, right? You would just be looking for a possible downtrend and revisit the lower bound of the range, right? So there is a swing trade here, and it's as follows. The long entries are now, stop goes below there, and you're targeting the top end of the range. That is roughly a 2-to-1. Whether you want to use shares, whether you want to use call debit spreads, it's up to you, but there is a slight swing trade here on Tesla. In terms of long-term positioning, you guys know the drill, right? If you believe in the long-term thesis, then this would be a buying opportunity. If you do not and are focused on the short-term negatives, you would deem this one to be overvalued. So it's really up to the eyes of the investor to make that determination. Moving on to Palantir. Palantir up 0.15%. They have earnings coming up in about 2 weeks worth of time right now. No new all-time highs, but very close. Daily uptrend is trying to be established by the bulls right here, right? That being said, anything above 145.76 on a pullback, looking for a new higher low. If we can't get it done, maybe even tightening range, bull flag before further push. The one thing you got to watch out for, though, is if they put in a daily downtrend. Now, I'm not really expecting Palantir to go into weekly consolidation before earnings. If anything, they'll probably hold price leading into earnings. You're getting a little bit close right now. The one focus of earnings, though, guys, is going to be on these growth rates. If Palantir shows, right, if Palantir comes in line with expectations or does not show the growth rates that the market wants to see, the price will be unwound quite rapidly, guys. So please keep that in mind. Be careful with Palantir right now, especially if you're holding short-term options because you're just overly bullish on the stock. Eventually, guys, if there is any faltering in earnings, and I'm not saying earnings are going to be bad, but if they come in either at par or slightly underwhelming, and I'm talking about like instead of posting 35% revenue run rate growth, if they post like 33%, it's still great. But the market will drop pretty hard on that, so keep that in mind. That being said, if we do have an earnings drop, you're looking for a higher low. Anything above 129, looking for a new higher low on Palantir for possible further trend continuation. But that being said right now, the bulls remain in absolute full control of this chart on every single time frame. It's just the valuation right now. You're paying for a lot of growth the next 5 years. Moving on to SOFI. SOFI down about 0.23%, but they have earnings on Tuesday morning. So we're probably not going to see many new all-time highs, or rather not all-time highs, but many new net highs on SOFI prior to earnings. And you may not even see a big breakdown of the stock prior to earnings. It might just hover around only a few days of price action prior to that. Now, earnings is probably going to move the stock about 8%. 8% up would put them beyond the, or rather into the resistance range, which currently stands at the highs of 2021. 22 up to about 24.50 is that target. And any unfavorable results, reactions to earnings, not necessarily that they're going to have bad earnings, but you've seen what's happened to many companies over the course of the last 2 weeks. They can have great earnings, but if the stock is, has rallied too high and the earnings are not good enough, they just get beaten down, right? If we do get beaten down, I'll be a big fan of playing SOFI. I'll be sitting here with some short puts, 18 to 17. Matter of fact, I already have some. On Tuesday's decline, I opened a position for SOFI down there. If they come down and pick me up, fine. If they don't, I will gladly collect all the premium that I've received for those contracts. So it's a win-win for me, guys. So just pay attention to earnings. We'll cover them on the channel. Stock's not looking too bad right now. Moving on to Uber. Uber down, or rather up about 1%, but still very awkward candle for Uber. Kind of just looking for a lower high into lower low. The bulls have given up a lot of momentum right here. If we do get the lower low breach of the lower bound of support, 90, you're looking for a daily downtrend, and that would just be synonymous with a bit of weekly consolidation, guys. So weekly bulls are in full control right now, just looking for a higher low. Anything above 82, looking for a higher low. I'm a big fan of playing Uber. If Uber comes down a little bit more, and I can find some short puts down here, lower 80s, I'll be a big fan of playing this stock. I actually don't mind the valuation, lower 80s. Where I draw the line is like mid 90s to 100. Then the valuation starts to run a little bit away from you. But if we come down again to the lower 80s, you might find me add some shares. I haven't added shares to Uber in a long time, since like the 60, 70 location. That was truly when the stock was categorically undervalued, no matter what metric you were looking at. I would say that the valuation now is fair to slightly undervalued. You can make an argument for that, but it's not cheap, right? Moving on to TSM right now. TSM up about 0.53%. The bull's not looking too bad. We still have a nice daily uptrend underway. I mean, it's been a daily uptrend this entire time, riding the 12 EMA, daily uptrend, higher highs, higher lows, perpetual higher highs and higher lows right here. In the event, guys, that you are unable to push new highs, and the next price target for TSM would be 250 psychological. If you can't get that done, and we unwind right here, daily downtrend and a loss of the 12, you know the drill. Just use Netflix, right? You're just looking for a higher low, the result of which could come down into the 225 location, retest of the prior all-time highs, and the 12 EMA could be curling into that nice location as well. That'll be a very nice opportunity to maybe add some swing trades or maybe sell some put options under the market. If you do find that correction, you don't know if it's going to come this week, next week, in August, or in September. It could happen eventually, though, right? Some of these names are, let's just say they've ran a ton, right? And corrections are possible. After such high rallies, you can get some corrective action if the overall market comes down into a bit of a downtrending cycle, right? In terms of seasonality, the S&P kind of struggles into the fall. So we'll keep in mind all of these semiconductor plays as we move into the fall together. And the valuation right now at 245 is quite manageable. So it stands to argue that in the 220s, it's still going to be fairly priced, in my opinion. So I will be a net buyer of TSM shares and also swing trades if ever we revisit the 220 location. But nothing for me right now in terms of swing trades. I think you're kind of at the top end of it right now, right? The risk-reward profile is not the most attractive, is what I'm saying. That being said, that's everything I had for you guys for the overall market rundown. Now let's spend a few moments describing the biggest gainers and losers of the day, shall we? Okay, so we're going to cover these quickly, and we're going to start off with some of the biggest losers of the day, right? So Chipotle, they had their earnings. We covered them yesterday. This one only becomes a buy for me in the lower 40s. We will reevaluate trade capacity if it does make its way down there. Still a little bit overvalued for me. The airlines, right? So the airlines, we've talked about this when I covered UAL earnings. Airlines are not something that I do play. My favorite plays are not necessarily for travel speaking. It's not the airlines, guys. My favorite plays for travel are companies like Booking.com with very resilient business models, capital light businesses as well. You can think of companies like Airbnb. Airbnb, if we're looking at travel and hotels, Airbnb probably my best bet because it's been consolidating here for so long. A lot of accumulation might just be looking for a pop. So Airbnb is probably one of my favorite bets, but I am not playing the airlines. I know I could do more analysis on the chart, but it's just something that I'm not willing to play. And if I'm not looking to play it, guys, right? And if I don't have confidence in the sector because it's such a capital intensive business, such a cyclical business, I'm just not playing these overall. And if I can't play them, I'm not going to sit here and kind of recommend you guys some plays either if I don't believe in them, right? Rocket Mortgage coming down a little bit. They had the pop after they got picked up by the meme crew on Wall Street Bets, coming down a little bit. That's fine. I still do believe that Rocket Mortgage is a fantastic company into the next few years. We had some great call options that we bought back here in the month of May. We took profit on some of the call options at the highs, and now our trade is free. So any pullbacks right now, I'll be looking to sell some put options, maybe 14s down to 13s again, depending on how fast we drop now that the volume is coming out of the stock. But overall, the stock is moving well. We know that they've acquired Redfin, and they've also acquired this company that reported earnings just the other day, Mr. Coop Mortgages, which will be assimilated under the Rocket Mortgage brand. This one's still one of my favorite plays, guys, for the housing market recovery for the next 2 years. So it's a multi-year play. I would not be surprised if Rocket Mortgage can indeed make it back to the $20 mark. Tesla, we've already been over. On semi, guys, this one is kind of coming down because of the analog portion of semiconductors, right? Texas Instruments reporting bad earnings the other day. That contributed to bringing the sector down overall. And we also had a company like NXPI, which also does a lot of analog stuff, a lot of consumer-facing stuff. We know that PCs, electronics, personal phones as well, automobiles, they've all been in a cyclical downtrend over the past 2-3 years with high interest rates. And as a result, just not the best bets, right? So although On Semi is a fairly cheap company, right, in terms of the semiconductors right now, it's not my favorite bet in the market. So I will not be playing this one. Bros coming down right now. Bros for me is somewhat maybe a look down here in the lower 50s, though. They have earnings coming up, guys, very quickly, very shortly, right? In about 2 weeks' time. I'll probably wait till earnings. We know that it's been tough, right? Domino's has been saying that it's a tough landscape. Chipotle said it's a tough landscape. So today we had a lot of pullbacks and everything food and beverage associated with the consumer. So before playing bros, I'll probably wait until earnings. For me, though, I'll reevaluate this one if it can come down to the lower 50s. As of right now, the valuation, I don't know if I have it on the chart. Sadly, I don't. I'll do it for you guys when we come closer to earnings, but it's not cheap right now, guys. Bros is really not cheap. It's a good business model, but they just don't have the international exposure that some other companies have. Honeywell coming down about 6.18% today. Honeywell, for me, is possibly a revisit. They will be splitting the business into 3 components. So in the event you want to wait for that split, for that, divestiture to happen, essentially, you can wait. But Honeywell is a very solid company, guys. I don't own it personally for my long-term portfolio, but there could be a bit of a swing trade coming in if we backtest support down there. I'll let you guys know what I think in terms of when it comes into there and how it comes into there. But earnings sadly coming down for the company today. Kava, another very highly priced, food and restaurant chain right now. At $74, we did this valuation last earnings, or maybe 2 quarters ago. The valuation hasn't changed. At $74, guys, it was very expensive. Very, very, very expensive. Forward price to earnings is very expensive, right? Price to sales is in line with McDonald's, but McDonald's is arguably a much more resilient business model. They're growing well. They're opening a lot of restaurants here. Kava, sadly, is not a buy for me. I think they're kind of fallen out of favor. Just food and beverage overall, guys, for me right now is a very tough landscape. If I had one company to buy, it'd probably be McDonald's. McDonald's right now for me is a buy. They have earnings coming up in about 2 weeks' time, but it is a buy for me. Pullbacks here in McDonald's, when we usually test the 12 and the 26-month EMAs, those are buy criteria for me. It's not going to move as fast as Kava. Kava used to be a play that I used to play when it was on its exponential rally here last year, but ever since I have not played it, the valuation has kind of caught up with this one. CoreWeave. CoreWeave is going to be a play for me, guys. You guys know what I do on CoreWeave, yeah? Every time it has big drops, I'll be looking to sell puts under the market for very attractive prices. Take a look at the prices right now in terms of where we stand for short puts into next week. I'll be looking to sell some put options on this one for the end of next week. They have earnings August 12th, so I won't want to play the week of earnings. But look, you can get all the way down here, guys. $100 strike for next week. That's a big sell-off for CoreWeave, right? So I'll be looking to play some distance on some short puts, targeting the next area of support. I'm not starting any swing trade longs right here. Why? Well, because the daily bears are in full control of this one, right? It's very clear. When the bears are in control of something, rather than trying to pick reversal points, let them show you the new daily uptrend. Let them show you weekly consolidation is finished. And then when you have a temporary bottom that's set, when you've established a daily uptrend, the stop loss would go below there because that would be their weekly low at that point. And then you're targeting weekly levels of expansion. So for now, I'm only playing this one using short puts, selling them deep under the market. And that is all we're going to talk about. We'll talk about UNH and all that stuff tomorrow after Centene earnings because they're going to move a lot more, but them acknowledging certain things today, right? There's a lot more stocks we can talk about, guys, but we're kind of running out of time here. Oklo and the nuclear plays, they've been very, very, very attractive, guys. I was saying the other day that Oklo, possibly a bid for some short puts, but now, it's gone, right? There was no swing trade entry for me. The swing trade entry long was back here with a clearly defined stop loss there. Now you're actually coming into the take profit zone. So anybody who had swing trade positions from here, this indeed would be a take profit zone. Keep in mind, guys, like these companies, they have a very hot narrative right now, but none of these companies are generating any revenues until 2027. So the market is just bidding them higher and higher and higher and higher. Look at these revenues. You're talking about a company that's $11 billion in market cap with no revenues by like 2029. So this is all hype. This is all momentum. SMR is the exact same concept. So you have to play these level to level. I'm not opposed to playing narratives and momentum, but you have to play them in a realistic fashion, right? Target pullbacks, establish areas where the bulls start regaining control. The entries go here, the stops go below there. You're waiting for daily bulls to recapture control or just areas of back tests overall into established EMAs. No trade on SMR for me right now, but congratulations to all the bulls right now. Just understand that you're pushing the top end of valuations on a lot of these companies because they have no revenue, right? I'm okay with playing momentum. I'm okay with playing hype names, but you have to play them level to level. Please have defined stop losses and take profit areas. Your take profit area should not just be, any arbitrary number. You should just be looking for defined psychological levels. And right now we've cracked 50, so that would be one for me. T-Mobile performing very well after the earnings today, right? Clear downtrending channel right now, which you've now since broken to the upside. So looking not too bad, guys. If you do retest the bottom end of this, it would possibly be a swing trade long. The bulls are looking to do a couple things right now. It's been a weekly downtrend for a while, and now we got a weekly uptrend, right? So now is the time to position possibly as your monthly higher lows are set. You're looking for a little bit more upside appreciation. So I would not be opposed, guys, in the event that they can come back and pick us up. 240, not a bad opportunity for a swing trade. And I'll remind you, the stop loss will go below your weekly low here, 224. If you unwind that, the thesis is dead, right? But if you don't and just pull back a little bit, very nice opportunity to ride this one possibly back into the all-time highs. Not a bad look. Open door, you guys know how I'm playing this one. only invest what you are willing to lose. I still do believe that this one can squeeze a little bit more as the initial people take profits. Institutions start shorting this one again. More people start accumulating. It is part of a popular narrative right now, which is the comeback of the housing market overall and the restructuring of their business model. They're not actually doing too bad, guys. This company makes a lot of revenues in the next few years. Look at the forecast, right? With the restructuring of management, with the restructuring of the business model, although they won't be making much in terms of EPS, their revenues, right? Not bad, guys. Growing like 10+% per year. Just off that alone, you could see some increases in terms of price to sales. The company is trading very cheap right now, under $2 billion. You know, finding it back again, $5, $6 range, is maybe not out of the question. It may be a little bit higher, depending how much the momentum market takes it. So only what you're willing to lose, guys. I've been very firm on that overall. And that's pretty much everything we had, guys, to the upside, right? We can talk about so many more names, but sadly, we've now ran out of time. Tomorrow, I'll try to cover more of these names, but through earnings season, I'd rather focus on earnings and give you guys fundamentals because we've done a lot of these biggest gainers and losers. We've covered hundreds of stocks together over the past month since I've included this section. So hopefully you guys have been able to kind of gauge or get a sense of what I'm looking for when I look for swing trades. That being said, that's all I had for you guys today. Hopefully you enjoyed the video. Apologies for the late upload. Had a few things to do. And then the earnings prep for these videos is a bit on the longer side. So these earnings videos are always a bit longer, but I hope you guys enjoy them. If you did, consider dropping a like, consider subscribing to the channel as well. And if you have any questions, leave a comment down below. That's it for me. Take care. See you guys tomorrow after the close. Peace.